but what happens from here on for the investor community? That's what we'll be discussing today with Trideep Bhattacharya, who will just join us in a minute from now. Right, Trideep, good afternoon. Were you having calls in the day so far with your client community? What is the message you are sending down the as far as your own organization is concerned? How deep could the crisis run?
Good afternoon, Ajay. Thanks for having me on your show. Yes, I think the situation in Russia, Ukraine has really escalated over the week or so, and hence the volatility in the short term is going to be high. But I think we've been kind of running with the thinking that first half will have will be full of moments like this, where we'll have weak moments, where the markets would react to with a jolt on some of the events, which could be sudden rise in interest rates, which could be sudden deterioration of the geopolitical situation and stuff like that. So to that extent, not many frantic calls today afternoon so far. But yes, clients are a little nervous, and I think the message that we have been carrying through is that by and large we expect the first half of 2022 to be volatile. Driven by not just geopolitics, but also fears on inflation, and also with regards to the US interest rates and whatnot. In the second half of the year is when we think the earnings recovery would start to take some shape and form. So we have been advising investors to use the volatility in the first half to actually kind of gradually and steadily get invested rather than in a lump sum basis. So far things are in that context, in the broad range.
Right. Trideep, there is only one caveat out there, and that is if crude remains elevated for long due to these concerns, because Russia is a major supplier in the overall basket of crude which the world consumes, then how does the macro for India go for a toss, and how can your hypothesis be challenged in a way? Have you looked at that rising risk, emerging risk a little more closely?
Absolutely. I think overall our current thinking is that obviously the oil is elevated given the geopolitical situation in Russia versus Ukraine. But if you really kind of look further out, can the geopolitical situation remain weak for maybe a few weeks or a month or so? For sure, yes, we could. But can it remain the same way for next 3 to 6 months? If I were to kind of take a probability estimated guess, I would probably say not. And if that be the case, then it's a short-term blip that we are seeing in terms of the peak in oil price, and not just oil price, but say a few other commodity prices as well, because they're more supply-driven rather than demand-driven. And hence the thinking that overall beyond 3 to 6 months is inflation, which encapsulate all of these, will actually kind of will come down. The other aspect there is that at the moment in the markets also baked in is a certain level of interest rate hike, whether it's in the United States or in India. If inflation were to be kind of overall seen to be spoiling the economic recovery, then clearly central banks would actually kind of be more accommodative with regards to the interest rate scenario. I think the macro situation is a little fluid, will adjust itself overall over a period of time, and we are clearly watching closely where this can be. We are not macro experts. Instead, we are focusing on those companies which have good pricing power, can tide through this turbulent times, keeping to a certain extent their margins or earnings intact. So that's how we are looking to kind of tide this through this time. But we think that this is more a 3 to 6 month issue rather than a year issue. If it goes beyond that, then certainly the cause of worries.
Right. Trideep, what is your sense on flows? The third front, the SIP flows and the big HNI retail flows, which have been very sticky and in a sense have been supporting the market so far, absorbing the FII selling. Do you see any risk to that number going lower in this kind of time, or do you think that will continue to support the market?
I think overall, some part of clearly the retail HNI flow is structural. I think given the relative attractiveness of debt versus that of equity, a lot of people over the last year or so, and fueled by the gains, have been attracted to the equity markets, and some part of this will actually continue over the medium term. But at the same time, in certain stocks, particularly stocks with low institutional holdings and which have done phenomenally well, there has been in the past good bit of froth coming through by one part of the driven by one part of the investment community. I do certainly see that in a slightly interest rate in a regime where interest rates are slightly increasing, that froth will certainly go away over the next 3 to 6 months, and hence we have to be very carefully, picking stocks rather than any macro themes, in my opinion, in the current environment. So on net balance, I do see, a bit of fraud going away from the market, particularly whether it comes from HNI, retail-driven names, etc. But I think some part of this will clearly be structural and will remain with us and will act as an additional cushion, particularly during times when FII flow will be remaining weak.
Right. Sudeep, let's for a moment assume that all of this has not really happened. What are your numbers telling you? What has your conversation with the team been regarding the quality of numbers? Say, some indications where the quality of numbers are so good that if 5-10% lower prices do occur in the market, those are the areas you would like to add in your fund.
So let me present a few data points, which is a sum total of the conversation with the companies as well as the research that we have done. I think for the first time in the last 10 years, we have seen private sector capex intentions being meaningfully higher than what we are used to the tune of basically 4 to 5 times that of public sector, which will not come immediately, but will come over the period of next 2 to 3 years. That's a very important data point to note, which is from a corporate capex standpoint. Second, we also are hearing that on the household capex or the real estate part of the economy, the inventories are coming down at a meaningful pace. And as the launches come about, I think there is coupled with the fact that interest rates are still low, there is a good bit of demand that the companies in that segment are seeing, and the allied sectors like building materials, etc. And third, for the first time in a good while, there has been a good salary hike to the tune in double digits. For the first time in 15 years, I was seeing a figure quoted around 15 to 17%, which has come about over the last year or so, which ultimately at some point will lead to consumer spending. So these are the fundamental data points which makes me feel that we should take the scenario over the 2 to 3 years, slightly look beyond the near term. The fundamental picture of the Indian economy with regards to, whether it is corporate, private capex cycle, or for that matter, household spending or household capex are really looking robust. And hence our hypothesis that, we are playing through our portfolios, certain themes like private sector investment demand and the rebound in credit growth. Those are the themes that we are playing as in our portfolio, which are a corollary to what I just mentioned. So that's why I said that, focus on the earnings, on the medium-term earnings potential, and we are seeing a few changes which are first time in a decade that we have seen, worth noting on.
Mid and small cap basket has traditionally always traded at a discount to large caps, but last couple of months it had gone to at par level, or in some cases even more premium to the large cap universe. Do you think this correction is putting order in that relationship also?
Great spot, Ajay. I would say that over the last 12 to 18 months, the rally that we've seen in mid and small caps has bridged the valuation gap that existed between large and mid and small cap. And hence today, the valuations are in sync with how the fundamentals look like for these set of companies. And hence, from an investor standpoint, we are actually trying to figure out which companies, irrespective of the cap, because large cap, mid or small cap, how the earnings upgrade story is likely to pan out over the next 2 to 3 years, and picking stocks based on that, rather than being governed by the fact that which cap category do they like. So in that context, yes, some of the fraud which have been there, which is the valuation premium that you talked about in the small cap, has corrected. And if the expectation is that they will go back to those levels, not so. I think going forward, the movement in stocks will be very contingent upon stock-specific earnings upgrade, downgrade story, which is irrespective of what the market cap is, but more specific to the company and the theme that they play on to.
One last question then. Between now and say the year end, which is good 10 months away, do you expect dust to completely settle down by that time? UP election would also be over. How big a factor that? Do you expect market to be higher by year end than where we are today?
So I think basically higher or lower is a matter of specific prediction, but here is what I would kind of leave the investors with in terms of the way I am thinking about. I am thinking that the first half is going to be fairly volatile. From the second half till 2024, when we have national election, I think we have a good bit of economic tailwinds which will be helping us. Some of the data points I mentioned in that context earlier, like corporate capex, household spending, etc. All of these themes will actually play itself out over the next 2 to 3 years. So my advice to investors, and this is what we are doing at Edelweiss Mutual Fund because we are bottom-up stock pickers, is to take advantage of this correction in the first half, correction of volatility in the first half of the year, so to speak. As you said, till the time the dust settles, to get positioned in the right stocks so that we can play on the recovery from there on, which in my opinion will last for 2 to 3 years. So that's the way we are thinking about in the way equity markets will pan out. In that context, 2022 would be a more volatile year than what we've been used to, particularly in 2021. We've already seen some glimpse of it. We might see more of it in March and probably in the first half of the year. I think relatively the second half, I would think, would be relatively more calmer than the first half of the year.
Right. All right, Trideep, we'll let you go on that one. Thanks so much for your time today. Time for a very short break, but don't go anywhere. On the other side of the break, we'll get you some big voices. Shankar Sharma, many others who spoke to us on how should this correction be approached for investors. We'll get you all of that after this break.